Two changes essential to reversal of a sagging oil market are coming into view. Supply expectations are falling, while demand looks, well, at least stronger than it did a few months ago. Since December, 2 of 3 important market trackers have lowered monthly forecasts for average 2015 supply from outside the Organization of Petroleum Exporting Countries. The International Energy Agency's March projection for non-OPEC supply is down 400,000 barrels a day from December, and OPEC's projection is down 100,000 barrels a day. The U.S. Energy Information Administration's March projection for 2015 non-OPEC supply is up by 740,000 barrels a day from a December forecast that was the lowest of the three, and that now, at 57.6 million barrels a day, is the highest. All 3 March forecasts for global demand this year are up from December values, by 200,000 barrels a day for IEA and OPEC, and by 810,000 barrels a day for EIA. Meanwhile, a zooming source of non-OPEC supply has entered a glide. In its March 9th drilling productivity report, covering March and April, EIA forecasts declines in crude production in the Eagle Ford, Niobrara, and Bakken plays, the first negative projections since the report started up in October 2013. With output in other plays still rising, the March projection overall is up slightly, while April is flat. Because tight oil production depends heavily on continuous drilling, when rig counts fall, production must follow. Drilling remains in a dive. The Baker Hughes count of rotary rigs active in the U.S. during the week of March 20th was 1,069, down 56 from the previous week, down 734 from the comparable week a year earlier, and down 862 from the last year's high in September. In all 3 plays where production has begun to change direction, drilling is down from last year. It's down in most other tight oil plays too. Production has lost lift. This is how the market sheds surplus when OPEC won't. This is how correction feels. I'm Bob Tippie, editor of Oil and Gas Journal, and that's the editor's perspective that appeared first in text at www.ogj.com on March 20th, 2015.